Good morning or good afternoon, and thank you for attending Solactive's webinar on driving change. How can your investment portfolio create positive impact? This morning's or this afternoon's webinar, depending on where you're listening from, will be split into two segments. Will be about 45 minutes long, so pretty short and sharp. Firstly, we'll have a panel discussion. We'll cover issues such as what is impact investing, its challenges and issues, then touch on a couple of pieces of advice for asset owners and asset managers starting to think about impact within fund selection or an investment process. The panelists I've got for you this morning, and Solactive have done a very good job in putting together three great panelists. Those include Oliver File, Chief Investment Officer at Sustainable Investment Management, Rashid Rasool, Managing Director at Cooler Future, Bernard Grunoldel, Head of Investment Strategy and ESG at Bayer Invest. Solactive certainly is sincerely thankful for their participation this afternoon. The second section will then be questions provided by the participants. Please place these as we're going along, either in the chat function or the question answer function on Zoom. And as the session progresses, we'll spend some time at the end answering as many of these as is possible. My name is Toby Belsom. I'm Director at PRI, and I'll be moderating today's sessions and leading the panelists in their discussions. So without further ado, I'd like to move to the panel discussion. And starting off with a real kind of easy one to kick us off. Impact investing means a lot of different things to different people. It makes it both fascinating and frustrating. What does it mean for your organization? And Oliver, maybe I can turn to you to start us off this morning.
Sure. Thanks, Toby. Thanks, everybody. Thanks for having me. So, very good question. Obviously, the starting point of any on impact, and I can tell you how we define impact investments within EB SIM. To us, impact investments are those that, alongside a financial return, can contribute to solving environmental, social, and ethical problems, and or mitigating the consequences of these problems, while intending to create real-world change. And this is really the core to this question, because this is really where impact investments differ from mere ESG investments. And we have to be very careful when we speak about all of that, because a lot of people tend to mix up ESG investments with impact investments, and this is not true. So impact investment is very different to ESG investments.
Bernard, maybe turning to you, kind of follow up from Oliver's start there.
Yeah, thanks, Toby. Hello to everybody also from my end. Yeah, I'm totally agree with Oliver that it is a different thing to do impact investing than to do ESG investing. At Bayern Invest, we clearly committed ourselves as a 100% ESG manager. And to give you a little bit of context, we have some 100 billion of assets under administration and a diverse client base. And therefore, even within our organization, we do not have a single one-size-fits-it-all definition of impact investing, as our clients are at very different stages of developing their own set of values and their own approach to impact investing. But still, for our own funds that we manage in our own discretion, we clearly said that we align our portfolios with Paris climate goals until 2025 at the latest. And I think to achieve real world impact, as Oliver also stated, it's necessary for us, and that's our definition of impact, that we not have a too narrow definition of impact and exclude companies and sectors per se from our investment approach, but rather try to engage with companies and also with our clients that are not there yet to do impact investing, and thereby achieve some sort of indirect impact, how I would like to call it.
Thank you, Bernard. Rashid, I know your organization's got a big focus on climate, but maybe kind of take that a couple of steps further without reflecting that focus of...
Yeah, sure, Toby, thank you. Yeah, Cooler Future, in addition to social and governance, so the S&G, the environmental or climate change aspect, is very important to us. We apply an impact-first approach. This is what we call it. What we're looking for are companies that take climate change seriously, and by that I mean that they have integrated climate change as part of their strategies and set ambitious emission reduction targets, or have otherwise transitioned like relevant parts of their business towards developing or providing solutions for climate change mitigation or adaptation. We don't look only for the best past performers, but those companies that can truly make a change and contribute to the transition itself. We believe merely investing in low carbon companies doesn't equate to impact. What is needed is action and change, both by the companies as well as investors to support and enable the kind of activities that help to achieve a zero carbon economy. If I give a quick example, so if we look at, they're usually green ETFs and funds with a climate change angle are constructed with reference to their benchmark indices. And green ETFs tend to be skewed towards low carbon intensive sectors such as technology or healthcare. But as my colleagues agree, what we look at here at Cooler Future is a kind of through a broader lens to highlight the fact that all sectors actually need to make this transition into decarbonize. And sustainability is, it's a really good indication that a company has thought things through, is looking into the future, and it has good policies and practices in place. And this, to me, is an insight into a company's wider management capabilities and environmental and social responsibility overall. Ignoring sustainability, and especially in today's world, is very likely to be reflected in financials sooner or later.
Okay, thanks, Rashid. Oliver, just kind of picking up on a couple of things you mentioned there. When your clients are coming to you, do you think they differentiate between something that's maybe aligned to an impact objective and something that really looks to generate impact, that looks to really invest and result in effectively a real world impact?
Yeah, thanks, Toby. So that I think that exactly aligns to what clients currently are asking for. We see, and I think this is also evident when we listen to what has just been said, and see what's going on in the industry. So within impact, the clients and also we usually distinguish between impact aligned and impact generating investments. In impact aligned, the materiality is indicated by detailed descriptions of outputs already realized, for example, by the degree of the SDG alignment. Thus, an impact-aligned strategy may invest in stocks of companies that already demonstrate a positive contribution to SDGs. Investors, therefore, when purchasing a financial product, are participating in a company that has already produced that impact. In the case of impact-generating investments, materiality is given by the measurement of the additional impact that is generated. Thus, for an investment to be impact-generating, there must be an obvious causal effect between the outcome and the investment. In other words, the outcome can be traced back to the underlying investment. And in this way, an indirect effect is achieved with the investor's money. So one example I can give here is our Sme Finance Fund Emerging Markets, where we extend credit to financial institutions in emerging markets, which in turn provide funding to SMEs. And this is in accordance to the principles of well-behaving and sustainability of our organization. Thus, we effectively provide liquidity to the so-called missing middle in emerging markets, where hopefully the bulk of jobs and income is being created to support a self-sustaining virtual cycle.
And Bernard, in terms of the clients that you're dealing with, the asset bank that they are manages as an organization, just kind of what your clients' reflections or your organization's reflection on that slight nuance that Oliver's outlined there about impact aligned versus impact generating, and that connection between investments and a real world impact?
Yeah, I think it very much depends on the level the client is already having. And there are clients that have really tailor-made investment strategies at times focusing on distinct SDG sub-goals even. So that are really those clients that know what they are looking for and what impact they want to achieve. That's the sort of client that wants to achieve a direct impact with their investments. On the other hand, I would fully agree that the indirect approach I mentioned is what Oliver mentioned as impact generating investments. And that's basically what most clients are looking for, because in the end, they want to align financial returns with ecological or social returns. And that's most often best achieved when looking for impact generating or indirect impact strategies, where you can benefit from transforming companies or transforming sectors, and thereby even achieve this financial return that is very much in focus for still most clients. And to add one thing, I think it's about setting the right incentives for clients, but also for investee companies, of course, to align the underlying financial targets of the strategy with the investee company strategy on corporate behavior. So it's, as I, for example, in a fixed income strategy, I would say aligning, for example, products like sustainability linked bonds, including them in an investment strategy makes perfect sense, because incentives are aligned between the investment strategy on the one hand and company on the other hand.
Rashid, maybe I can kind of almost build on that again with you, going back to your climate focus. You mentioned about Paris-aligned portfolios and a 1.5 degree and 2 degree aligned portfolios. There's lots of different terminology around that at the moment within the investment world. Maybe just expand a bit about how the level of certainty investors can have around portfolios which are marketed along those terms. The issues with data, for example. So
yeah, exactly. So I mean, one of the difficulties in this space is the data. So there are a number of initiatives that companies can sign up for, which makes what they're probably doing internally already. It's very good for them to do this reporting because a lot of investors are now looking at this kind of information. So this is there's a carbon disclosure project, there's science-based targets initiative, and there are many other initiatives like this that the companies can sign up for. And these initiatives also provide a lot of information on how companies can actually, I think a lot of times the difficulty is actually just how do we measure this? The companies are not sure themselves how to measure this. So this is something that that these providers also support as well. And this is, I think, definitely a way forward, is the more that companies can report, and not only their existing emissions. I mean, first of all, in order to decarbonize, they need to understand what's happening inside their business. What is missing. So they need to understand the missing piece, and then after that, see, okay, so where is this industry headed, and how can we decarbonize, and in what areas can we do it? Can we just, can we, add more renewable energy to our energy mix? Can we look at our suppliers and see if we can reduce emissions on that side? Or can we, try to make our logistics operations more efficient? So there's lots of different aspects of the business that these business owners can, company managers can actually look at and then report on.
And from your point of view, that you mentioned data being a key issue there. Did you see that as really the core, I'll call it pinch point or issue around impact investing more broadly? How do you measure that impact? How do you monitor it? How do clients really know that there is an impact being delivered within their portfolio? And I suppose linking on to that, is there a requirement there for regulators, which I know they are in Europe in particular, but elsewhere as well, to take a bit of a kind of step on ensuring standard information?
Yeah, exactly. So there's obviously some regulation coming in recently along those lines. So there's the EU taxonomy regulation, for example, and so I'll talk a little bit about that. So the thing is, with this EU taxonomy, it doesn't eliminate the potential for greenwashing, but it could actually allow some companies to hide behind it. We use it as a guideline to monitor the portfolio. What is important for us is to look deeper into the companies, like I mentioned, their business models and what exactly they're doing to reduce, reuse, recycle. Some of the things that we generally talk about. Also, there were recently some signs of EU taxonomy starting to become a political topic of discussion, as different activities were categorized as green or not green. So, that's kind of another gray area. Ultimately, the practical implementation of the taxonomy will show to what extent it will be able to direct capital to more green activities. Currently, I believe many companies are only getting familiar with the taxonomy and still have the implementation ahead of them. As you said, there's so much new terminology here as well. And for business managers who didn't, I mean, actually, if you look like Japanese companies, for example, have been at the forefront of this kind of thing much earlier on. So they are also a good model for us to look at and see how, what is the governance and how are they doing that. And ESG, metrics have kind of played a more significant role over the last 10 years. And so reporting has increased a lot. I do hope the complexity of regulation will not come in the way of what needs to be done the most, which is companies and investors recognizing the most sustainable and green activities and supporting them. In terms of SFDR, for just add a couple of words on that, so the sustainable financial disclosure requirements. On the other hand, I feel this is a very good development, and our fund aims to be an Article 9 compliant fund, also known as a dark green fund. It's another new word out there now, which means that we need to maintain a high degree of oversight and transparency, and that's exactly what we want to deliver. So we're very happy about that.
Bernard, Oliver, I just wanted, again, issues around data and the requirement, the need for regulation in terms of clients getting the correct information to make informed decisions. How do you see the likes of the EU taxonomy and SFDR impacting on the way that you're marketing, developing, and structuring product?
Yeah, so clearly, sorry.
I don't know, I was going to say, Oliver, go ahead.
So clearly, the more differentiated the topology for sustainable investments is formulated, and the more widely it is used as a reference by the providers of investment products, the more transparent targeted investing becomes for both institutional and private investors. So to me, a uniform nomenclature and standardization creates a necessary credibility through the comparability of office and reduces thus also the likelihood of greenwashing office, and in consequence also resulting loss of trust. So clearly, I would say all the efforts undertaken by the EU in terms of setting a taxonomy and putting it in place are going in the right direction, because we're getting there. We're getting to a very clear and standardized, harmonized set of rules in terms of reporting sustainable investments. However, having said that, obviously we're just not even halfway through this process, because the EU taxonomy so far only covers 2 out of 6 of the green targets of the EU. So there's 4 still coming up. And then we even haven't talked about the S and the G, right? And so I think to look at investments holistically and not just from one perspective, namely the E, it's important, that we gain speed here and get this out quickly. And in addition to that, I think what is clearly, then the ultimate trigger that will make investments really, become the effective trigger for more sustainable development is that the advisors who are in the end dealing and advising end clients, take up all of this information, digest it, and use it in this way, that takes client preferences very seriously, and then get out the advice, in the right form and fashion.
Brennan, I don't know whether you've got anything to add to Oliver's outline of the issues there.
I totally agree. Data availability is improving, data standardization is improving, and that all is very helpful for us as investors and creating, so to speak, a level playing field for us to have some sort of common definition. But still, we are not there yet, and there are a lot of missing pieces, and it's at this point in time, we still need to take this holistic approach, and because simply that an impact or an impact generating investment cannot be measured correctly doesn't mean that there is no impact at the moment, because simply companies might not be able to report the underlying information in a consistent and sufficiently transparent way. So it's really about data availability, about data transparency, standardization, but also about getting the right data from the regulators. And it's, at my view, it's simply, we have created a lot of paperwork with taxonomy, with SFDR, but it's not always that helpful if in the end, for example, national regulators are not all taking the same interpretation of the existing rules, and that making it also difficult for us to have some level playing field on that area.
Thanks, Mandy. I've got a couple of questions from the audience, which I'll come back to later on. Please feel free to add those as we're going along, and we'll come to those in about 10 minutes or so. Kind of moving the topic and moving the discussion on a bit, one of the things, one of the really big trends within asset management broadly has been the growth in passive investment. And then when you look at the subset of that, and ESG passive in particular, the growth has been absolutely phenomenal. There are now thousands of indices measuring various different aspects of ESG performance. And where do does that kind of growing nascent trend in a sense about impact investing, you differentiate there between impact aligned and impact generating, overlap and collide with passive investing? It comes to back maybe to what you touched on initially, Rashid, about Paris-aligned portfolios. I don't know whether you've got any further follow-ups regarding that.
Yeah, I mean, I would just add that, we use, I think it's good that we have these benchmarks. It's very interesting. It's very helpful for, people who are not as informed on these specific topics. But we use benchmarks internally for basically comparing, for example, the carbon footprint and the decarbonization rate against the broader market. The climate transition benchmarks and Paris-aligned benchmarks, even by Solactive, for example, are interesting and good benchmarks for people to, at least as a starting point, to look into their portfolios and see where we are. And I think my colleagues here can, basically could add to that as well.
Do you think the key thing around the use of those benchmarks is around performance measurements or impact measurements, or both? What do you think is the real key about a client and asset owner selecting an ESG benchmark?
Yeah, I mean, on our side, so we look at, in terms of performance, we look at both financial performance, which everybody does, the financial risk return, but also what's really important for us is climate performance. So how is the portfolio decarbonizing? Is it Paris aligned? Are we going in that direction? So both aspects of performance is what we categorize as performance. And, and each fund, I guess, has their own set of philosophy or to guide them in what is important to them. For us, okay, the S&G are very important. Companies need to have good governance and social aspects as well. But climate is a key area for our focus for the time being. So this is, I think, having that relevant benchmark on its own. I think it's not, like I said, it's a good starting point. But the climate transition benchmark, for example, may not look at other aspects of ESG. So that's where we come in actively trying to manage this.
Oliver, Ben, I don't know whether you use ESG passive indices with within your own bench of clients, as it were, and how those clients use the benchmarks for what purpose, measuring impact, measuring return, both.
Yeah, I guess.
Ben, I don't know whether you want to start there.
Sure, thanks. I would say they are indeed an interesting reference point, in particular for the impact of this instrument, because for financial performance, we and our clients as well are still very much trying to beat the broader market and the investment universe as a whole, so to speak, and rather the Paris-aligned benchmarks or transition benchmarks are used as a reference point for the ESG orientation or the impact orientation of the investment strategy. And I would say, Rashid, that it's in particular in the fixed income space, they can only be a starting point for then having active investment decisions on top of that, because these benchmarks are very much backward looking, I would say. They operate with sector exclusions, they operate with reducing carbon footprint, and the only forward-looking instrument is self-decarbonization. But you need, as an investor, pick the right investee companies that put themselves on this decarbonization path in order to have forward-looking information in your portfolio, which the benchmark obviously doesn't have. So it is a good starting point, but it can only be that starting point, and especially in fixed income, I would say.
Oliver, I wanted to turn to you and picking up actually one of the questions in the chat function as we're going along about climate benchmarks and that balance of, mitigation versus adaptation, and how you can think about benchmarks in the context of both, whether it's just about excluding fossil fuel businesses, or whether there's a bit more nuance in there. There's other aspects here which are important from your own perspective. Whether you use ESG benchmarks as an organization.
Yeah, we do use them in terms of reference and in terms of both performance and also impact. So clearly there is a use case for them, and I imagine that in the future they would also take a much bigger role in the overall index space than the standard benchmarks, because I think passive is really also focusing the flashlight on where the action is, and this is clearly impact investing today. So once passive moves there, I think the attention will also go there even more than it's already in the past done so. So to my mind, I would say, sure, the benchmarks are necessary to have, and they will have their clientele and their investors, looking to invest. But I would also want to caution that it's certainly, the lack of qualitative assessment and the determination of the impact that makes active still the name of the game in the impact side. To give you one example, from our practice, we had been looking to add a stock to a ecological portfolio, focusing on SDGs, of the ecological SDGs. And one of the companies that showed up there in the screening was a large brewery. And they were highlighted there because they were an environmental leader due to the waste reduction, the reducing of water consumption in the brewing process, promoting female leadership. However, the screening obviously does not take into consideration the nature of the business. So the production of alcoholic beverages and also the detrimental impact on public health. And this is something, that I would say is important when you do impact investing, because you don't want to do something good on the one side and have a detrimental effect on the other hand on other SDGs that you might not be actively targeting. So I guess, this is something where you need to have a holistic view on, where you need to have an active stewardship on the portfolio.
So I'm going to put some words in your mouth, Oliver. Impacts generating investment strategies are mutually exclusive to passive investment strategies. Would that be a kind of a view that you probably share?
Yeah, I guess it's going to be very tough to have a passive strategy that is the impact generating. So under the definition, at least that we are using here, it will be very tough.
Yeah, but it comes to the impact aligned, where
exactly
that comes into your angle there on Paris-aligned portfolios, 1.5 and 2 degree.
Correct.
Good. Okay. Thank you. I wanted just I've got another question there actually, which I wanted to go back to in the chat function, which has come up on SDGs. And I think we've done quite well. We've gone half an hour without mentioning UN SDGs at any point during the discussion, so that's brilliant. However, it's clearly a concept, a framework that is increasingly utilised, increasingly talked about in terms of impact investing more broadly, and its application across ESG investing as well. I just wondered whether the three of you had any thoughts about the function that it provides within your own investment strategies and the way you approach building portfolios and kind of marketing product to or discussing issues with clients. But Bernard, I don't know whether you're nodding as if you've got something to kind of add in there. Maybe you could start.
Sure. I think still most of the time clients are looking to achieve or generating impact on one specific SDG goal or even sub-goals, as I mentioned before. We have one, to give you an example, one equity strategy that is trying to generate impact on SDGs as a whole. And I would agree with Oliver that it's always important to look at the side effects on the one hand and not getting negative impacts on SDGs with your investments, but still you want not only, at least what we do in this equity strategy is we want to generate impact on more than one SDG goal, and that's still possible without conflicting with all the other goals. So I think it's an important concept. It's a helpful concept, and you can perfectly use it in portfolio generation, and that's great. But you need to have a look at the side effects of your investments, and there are of course indicators available that give you some sort of filters to do that. And that's why we usually when generating impact strategies or SDG strategies, we have some sort of multiple layers within our investment process that on the one hand filter out companies that do harm to specific SDGs, but on the other hand they should at least generate positive impact on at least one SDG on the other hand, and therefore you need some multiple layers. I would say.
Rashid, I wondered. I know climate futures has a climate focus. The climate is an important bit of the SDGs. I don't know how you adapt that framework to your own thinking, or whether there is an obvious overlap.
Yes, absolutely. I agree with my colleagues as well. I think this SDGs are a great set of principles, and I think these development goals are something universal that could be applied globally, and so we do consider them in our framework as well. And like climate action and a few of the SDGs. Also, I mean, there's a huge overlap, right, with the ESGs and SDGs. So I think it's very important for us and take it into consideration. So I think it's not much more I can add on that front, really.
Thanks. We've got kind of 10 minutes left. I've got two kind of further questions, and there may be some more on the chat function as well. I think first one, from your own as a panelist and your own organization's experience about thinking about impact investing as a strategy, what would be the one piece of advice you give to managers starting off considering incorporating impact in some way within their investment strategy, within their product development strategy? What would be your starting point? Oliver, maybe I could send to you first.
Sure. So my advice would be to create a framework to define your impact goals, right? Because you want to know where you focus your investments on, and this also, if you go back to the prior points in the discussion, obviously, different investors have different targets for their investment, and so clearly, it will help to structure, the set of SDGs or sub SDGs into a framework that fits your purpose. And then, obviously, the second piece of advice would be, to go out and look for a credible manager. And that's the key, I would say, in terms of how to set up such a function inside your firm.
Bernard, I don't know whether you've got a kind of a single piece of advice Oliver sneakily snapped to there, but it doesn't matter.
I think the first piece of advice would be create transparency among your investments and achieve that level of transparency that makes you confident that you are really achieving that impact that you want to achieve, and that you are pursuing your investment strategy in the right direction. And the second piece of advice probably would be, instead of narrowing down your impact definition too much. I would rather say keep on trying and try to achieve positive impact instead of give up and don't generate impact because probably a measurement is difficult or your investment universe is too small if you narrow down your impact definition too much. So that's probably those two pieces of it. Okay.
Yeah. Both got two in. Rashid, I wonder whether you kind of had a bit of advice.
Yeah, absolutely. So I'd say just look deeply inside your portfolios. Use a different lens when you analyze portfolio companies. Check what is the carbon intensity as well. In addition, if you're already doing looking at these aspects, so look further inside that. Look at the carbon intensity of the revenue generated from the business. How does that compare with its peers? How will that look if and when carbon prices increase substantially, which they already are? What will the sector need to do in order to decarbonize? What can the sector, how can the sector become more sustainable? What are the individual companies doing? What's the renewable energy use, which I mentioned, recycling of materials, sustainable sourcing of input materials, efficiency of operations. I mean, to be honest, I could go on there's a lot of different aspects, but just to keep it short, I'll just say, look, all these things are very important to give you insight into whether the company and its products are really sustainable. So do your research, because that's what matters most at the end of the day.
Thank you, Rashid. Just one final question. You're almost putting another hat on in terms of your own positions and your own organizations. You're sitting there as a trustee selecting an asset manager for an impact investment strategy. What's the one single question, the one area that you really need to understand about that asset manager's approach to get that selection, that key choice correct? Bernard, maybe I can turn to you first.
That's a hard one, definitely, because in the end, it's about getting the right definition of impact and getting the confidence that the asset manager is aligned with your impact definition. So as we do not have a similar or single one-size-fits-it-all impact definition, that's probably the most important question, but also a hard one.
Oliver, just kind of following up on that.
Yeah, I would turn the table and say, find the credible asset manager and ask him what is his framework for reaching the impact goals, and how does he structure the SDGs in his world. And I guess it boils down to finding out, can you be confident, that the manager is really the most credible you can find for reaching your purpose.
Thank you. Rashid?
I mean, like my colleagues here said, what does impact mean? So I would ask this question: what does impact mean to you, and how do you achieve it? Or otherwise, tell me about your investment philosophy and how you live by it. And looking at responsible investment policies, so seeing the details of those, and I think those things are important. Yeah.
Thank you. I've had a series of questions which I think we've weaved into the discussion as we've been going along, so thank you very much for those. I think I'd like to tie everything up now from Solactive, and I'm sure the participants of the webinar this afternoon would like to thank the panelists, Bernard, Oliver, Rashid. Thank you very much for your time preparing for the event this morning and giving what was a very interesting, diverse and rich discussion around impact investing as a topic. Before I close, I just wanted to highlight on behalf of Solactive, next week is the final Solactive webinar, and that's going to be around real estate investing. I'm sure it's at about the same time, but if you watch the Solactive website, they'll be able to inform you kind of all the details of that. With that, I'd like to thank the panelists and thanks Solactive for organising the event, and close up for this morning. Thank you.
Great. Thank you very much for having us.
Thank you.
Thanks, everybody. Bye. Have a good day.